Hello and welcome to Express video which are relevant for ACCA paper F7. Remember, these are based on our Express notes which you can find on our website at www.theexpgroup.com. We'll look now at chapter 2, which basically talks about IAS 1, about the presentation of financial statements. IAS 1, it's a cornerstone accounting standard which is fairly relevant at AF7. Question 2 in the exam, it will be based on IAS 1. What I'm saying is that you will be asked to produce in question 2 of the exam a set of the financial statements, meaning either a statement of financial position or a statement of comprehensive income together with a statement of changes in equity, starting from a trial balance. You'll be giving a list of accounts, in other words, with a different valuation. You'll have to do some adjustment and then produce financial statements. So, in this standard, basically, we will know what are the components of the financial statements, what are the core concepts, and again about the same true and fair view override, which is fairly straightforward and it was already covered in the first video. Components of the financial statements. What do we mean by those? It's not the elements which are actually covered by the conceptual framework, is the components. How should the full set of financial statements actually look like? What should it comprise? And it will have to have a statement of financial position, which, as the name says, will reflect the financial position of the company at the year end, and that was previously called as balance sheet. A statement of comprehensive income, which will comprise a profit or loss statement and a statement of comprehensive income. And in here, IAS 1 is giving us a choice. Either we produce one statement, which comprise both elements, or we will produce an income statement or a profit and loss account and a statement of other comprehensive income. What do we mean by other comprehensive income? It's all other gains or losses which are, if you want, not realized yet. That's why we do reflect them in reserves. It will contain a statement of changes in equity, a statement of cash flow, which we will cover on a separate chapter and therefore video together, and comparative data for the previous year for each of the above. So for all of them, when you read the full set of financial statements, we will see current year and also you'll see the prior year column. In addition, there are secondary statements which are required, and these are the notes, or in other words, the explanatory notes, which will actually detail the accounting policy and other significant information which is actually required by different IFRSs. In question 2 of the exam, you will be asked to produce either a statement of changes in equity or together with a statement of comprehensive income or a statement of financial position for an individual company. You need to pretty much know the pro formas which will be covering together with core concepts included in IAS 1 are the following. A fair presentation. So basically, when we are producing or we are including transactions in the financial statements, that one should be presented fairly, neutral, and that, to be honest, it will mean a lot of things. So a fair presentation will require substance over form. So I need to know what is the substance of the transaction, not just the way in which we have written the contract. It's especially valid, for instance, when we talk about accounting for leases. That's why a financial lease, based on the nature of the transaction, it will be reflected not as we actually write the contract in order to look like an operating lease. it will actually comprise the selection and consistent application of the same accounting policy, and that will be actually covered in detail in IAS 8. The information that we present should be relevant, reliable, comparable, and understandable, as we have seen before, for the users of the financial statements. And we do have to produce a full set of disclosures for all material transactions, so the users will better understand the impact of particular transactions on the financial position and performance of a company. That would be fair and neutral descriptions of the transactions included in the financial statements. Going concern is exactly defined by IAS 1 as it was in the conceptual framework. The company should continue to trade at the same level in the foreseeable future. For us, foreseeable future would be 12 months after the end of the accounting period. If not, remember, valuation basis will be totally different. We will be using breakup values and not evaluation prescribed by certain IASs and IFRSs. Accruals, again, all transaction matching concepts should be reflected in the financial statements that happened during one accounting period. So we are able actually to match the revenues with all the associated expenses incurred in a particular accounting period. Consistency of presentation. Use the same accounting treatment for like transactions from one year to another. And we will learn how we should basically maintain this requirement, even if we will be forced, for instance, to change our accounting policies. Materiality and aggregation, okay? So each material class of similar items basically should be presented separately in the financial statements. We don't need to present the information about immaterial transactions. For those, we are allowed to aggregate them and present them. So that's why I will have, for instance, current and non-current assets, current and non-current liabilities. That's why I will have accruals in the financial statements. In here, materiality is pretty important. What do we mean by materiality is if I omit something from the transaction, some financial statements, or if I misstate some elements of the financial statements, irrespective if I'm talking about liabilities or I overstate, for instance, income, and this will be material if would influence the economic decisions of the users. If will actually make them change their economic decisions, that would be a material element. Offsetting, that is as little as possible throughout any IFRSs, okay? So do present the liabilities and assets separately, do not net them off. We are not allowed to net off, even if we talk, for instance, about cash at bank. And if we have actually been using two bank accounts, one in which we have a positive balance of $1,000 and the one where we are operating in an overdraft, okay? We cannot present the net effect, and that is with bank number 1, and that is actually held with bank number 2. We cannot present a net cash position of just $200. Because the risk basically associated with having balances with two different banks will actually influence the information needs of the users, okay? Imagine now that bank number 1 is bankrupt. Not only that I will not have on a net position $200 as an asset in the statement of financial position, all I will have is just a liability that it has to be paid. Frequency of reporting is actually covered also by IAS 1, and that includes normally an annual report. shorter if necessary, and certain disclosures will be made. So for instance, if we are basically traded on a stock exchange, we will follow also their regulations and produce basically quarterly accounts. Comparative information in respect of the previous year should be presented in order to ease the comparison from one year to another or between companies. Standard talks about the true and fair view override also, okay, but acknowledges the fact that it is extremely rare the circumstance in which I should depart from the requirements of an IFRS, because if I will actually follow strictly the IFRS, that information which is presented in the financial statements will actually fail to give a true and fair view of the financial position and performance of the company. If this happens though, a full disclosures should be given in the notes, along with reason, the financial effect or failure to following whatever IFRS covers the respective transactions. In terms of how actually the statement of financial position, for instance, is actually comprising, this is a fair example of how statement of financial position will look like. This one is presented in group scenario, but it pretty much follows the same logic for individual company accounts. That's a list of all the assets and liabilities of a company at a specific point in time, meaning at your year end. And it will always start with non-current assets, where we basically will show them as property, plant and equipment, intangible assets, any investment that we might have, and biological assets. Then we'll put a list of what is current asset, meaning it will be used in the business within 12 months. Because non-current assets I will actually use in my business more than 12 months. So more than one accounting period. In terms of current assets, I will present them in the decreasing order of liquidity. It's important to remember this in the exam as a presentation point. If you don't remember, at least list them between current and non-current assets to get at least 1 mark. And we will start with inventories. Those are the least liquid assets. We'll present trade receivables, cash and cash equivalents, and any assets that we might have for sale. And that is a requirement coming from the IFRS 5, for instance, which we'll cover in a second. This will increase the predictive value of the financial statement that I actually covered in the previous video in order to close the gap between relevance and reliable information. The users will know that these assets actually will no longer be in the business next year. Then we present the other half of the statement of financial position, which actually deals with only equity and liabilities. And in here we will have the share capital, items like revaluation reserves, retained earnings, any other type of reserve that you might find into the business, and non-controlling interest if you are in a group scenario. Then we present the non-current and current liabilities, the distinction between the two being exactly the same thing. The non-current liabilities will become payable in more than 12 months. So everything that I have listed in here, like financial liabilities coming out from finance leases, for instance, deferred tax, any provisions that will become payable in more than 12 months. And current liabilities, which is something that I have to cover within the next 12 months. Pay out the current portion of the finance lease, pay out the current year-end estimation of tax, trade and other payables. Okay, and many companies will actually show goodwill, for instance, as an intangible asset separate, but within the non-current assets section. Biological assets, for instance, in accordance with IAS 41, they will always be presented as a non-current asset, irrespective if their life is actually shorter than 12 months. Assets held for sale I just covered when we basically talked about it. How will a statement of comprehensive income would look like? Okay, again, current year data, prior year data should be presented. And we'll also start with revenue, which is derived from our main type of activity. We'll show the cost of sales and gross profit as a difference between the two. Any other type of income that we may have, either from a sale of non-current assets, share of profits from associate, which comes from our investments, distribution costs, admin expenses, any other type of expenses will be presented along with a separate line for finance cost and finance income. That's mandatory. We have to show a profit before tax, a separate line for tax expense. And if you plan to actually discontinue an operation, we will have a line which is called profit or loss from discontinued operation after tax. And that is also covered by the same IFRS 5, which is dealing with non-current assets held for sale and discontinued operations. So again, enhancing the relevant information that we are producing for our shareholders, so they will actually know that the next year the profit that was reporting for a particular division is going to be sold will no longer be there. Then we show the profit for the period, and then if we're using one single set of statement, we will actually list anything else that is reflected in comprehensive income, and that would be property revaluation gains. There will be other gains which are reported directly in equity, share of associates and other comprehensive income, and other comprehensive income for the period total line. The profit reported will actually be splitted, if we are talking about the group scenario, between our parents and non-controlling interest. A third element of financial statements is a statement of changes in equity for the year. A statement of changes in equity, the easiest way for you to remember it in the exam is just a reconciliation of the equity section of the statement of financial position between the opening and closing balances. So for instance, if you take a look, we actually switch rows into columns, and we take share capital, revaluation reserves, retained earnings, and any other type of reserves that you might have in the statement of financial position, and actually reconciling the opening and closing balance with all the transactions that happened during the accounting period. If we happen to actually change our accounting policy, we will basically show the net effect by adjusting retained earnings. It was not the case, for instance, in our scenario here. In X3, which is, if you remember, the prior year, what we have to show is the total comprehensive income, which was reported for the period. Any dividends that were paid, this is the only way where you actually show the dividends, and if they were paid, you will be reflecting them in the statement of cash flows. Issue of new shares if it happened during the accounting period, and pay attention to a share premium account if the shares are actually issued at more than the nominal value, and sometimes transfers between reserves. What would that mean? For instance, in here we're actually moving something from revaluation reserve to retained earnings. And pay attention in the exam, sometimes the examiner may want you to produce this transfer, which is basically transfer the excess of depreciation based on the revalued amount over the depreciation that would have been based on the historical cost from revaluation reserve to retained earnings. And the current year we will be presenting exactly the same thing, okay? Share issues, if any, profits or losses for the period, dividends paid, so forth and so on. And in this way, the opening balance in the statement of financial position will actually match fully the closing balance. So, if you are in the exam and basically you are asked to produce financial statements starting from a trial balance, the first thing that you will be basically producing should be, the first one to produce, should be a statement of comprehensive income. Afterwards, the second to produce, it will be a statement of changes in equity, and then produce a statement of financial position, because in this way the figures will fall from one statement to another. So in here basically you'll have the profit and loss for the period, and you'll know the other comprehensive income, which you can take the data and translate it directly in the statement of changes in equity, where your opening figures is already available. And then from a statement of changes in equity, you just copy paste the figure into the statement of financial position, because that would be your year-end figures. Okay, it's highly unlikely that in question 2 of the exam you will be asked to produce all three of them. Okay, in most of exam scenarios it will be